Well, hello students. So let's pick up from where we left in the last video. Let's start from production. So in the last video, I was talking about marginal utility and diminishing marginal utility. And next up, we have production. So the very first thing that comes up is the definition of production, which is the act of making goods and services is called production. Okay. So, in day to day life as well, we use the word production and we mean the act of creating something. Okay, so anything that is in the process of being made is called production, right? For example, in a cotton textile mill, cloth is produced or manufactured by using different kinds of raw materials like yarn, chemicals, etc. Right? But this definition gives a very restricted materialistic concept of production. Okay, materialistic concept of production means that it is only talking about making materials, right? But production itself, the word production in economics means a lot more than that. So we shifted to the next definition, which means production is the creation of utility. Or we can say production is nothing but a process of adding utility to the object. So any object that is being produced, what is we adding to it? We are adding utility. Okay. What are the different types of utility that production helps in adding? It is form utility, which is one of the ways by which utility can be increased. Okay, it involves changing the form of a good from raw material to the finished product. Next up is place utility, where utility can be increased by transferring goods from one place to another, right? So suppose any product is being made at a particular place and then it gets transferred to another place so that people of that place can also get it. So that is called place utility. Okay, so something that is not being made in your city or in your state, it comes to your state, right, through transport facilities. So here we are adding a place utility to the object. Next is time utility, which is that the goods are made available at the time when they are needed. Next up we have service utility, which talks about results from the provision of personal services like doctors, teachers, engineers, transporters, bankers, retailers, etc. Okay, so anyone who helps to make goods or services is called a producer. Next up, we'll be referring to factors of production. So, what are the different factors that help in production? The very first thing is land. So land includes all those free gifts of nature like land, forests, minerals, etc., which are commonly called natural resources. Okay, so everything, all of these comes under land. Second is labor. So labor is the human effort, both physical and mental, involved in the process of production. So it's not just the laborers who are doing physical work, but it also includes the mental work that any employee is doing. Okay, so that is also included in labor. Third is capital, which is the man-made or produced means of production consisting of goods like machinery, tools, equipments, factory buildings, which will be used in future production in the making of other goods. Okay, and fourth but not last is entrepreneur, who organizes production, takes important decisions regarding production, and bears the risk and uncertainty involved in this production. Okay, so from here you can have so many questions like what are the different factors of production, explain them, or maybe who is an entrepreneur. So there are different questions that arises, and as I am explaining you these points, I'm also marking them with red because these are the points or these are the lines which you can mark in your book itself, because questions will come from and around these parts only. And so what you have to do is that you don't read the entire chapter all at once. Okay. First thing is you mark these important points and read them, end it, again read it, only the important ones. Okay. So you, instead of reading the entire chapter for like hours, you sit with your book, mark the important places from where questions can come, and read them again and again and again. Okay, that is how you study eco, because this is a very theoretical chapter right now for you guys. So you have to have the concept. Instead of like reading every line and getting bored of the chapter, you mark the important areas which you should be knowing and read them again and again and again, okay, before your exam. This is not something which you just give a one-time reading and you go and you expect yourself to be able to answer all these questions. No, because in eco, you will have a lot of logical questions, okay, and reasoning questions, which I hope you have also seen the questions yourself. Don't just refer to the questions given at the end of the chapter, but also try to solve other schools papers or your previous year's papers, because you'll have a lot of logical questions. Okay, so for that you need to know the concept. Next is characteristics of factors of production. So under characteristics of factors of production comes first, production is the outcome of cooperation among all factors of production. So all these 4 factors of production that we just read about, there should be a proper cooperation among all these factors so that some end product is coming up. Second, all the factors need to be combined in every productive activity, but to combine all the factors in a fixed way. Okay, so it's saying that all the factors need to be combined in every productive activity, but there is no necessity to combine all the factors in a fixed way. That means to produce one type of good, there is certain ratio of land, labor, capital and entrepreneurship needed. But to produce some other good, there will be a different ratio of land, labor, capital and entrepreneurship that will be needed there. Okay. Third, an important characteristic of factors of production is that it is the services of the factor rather than the factor itself that contributes to production. Obviously, okay, instead of just naming it, the services that the factor is giving, okay, the help that the factor is providing to the production is of need. Next, all the factors of production have a physical existence. Okay, so they are not some imaginary products, they are all tangible products. Next, an important fact about factors of production is that the demand for productive factors is a derived demand. Okay, now what do we mean by derived demand? Derived demand, this is the definition itself. If they ask you what is the derived demand, refers to the fact that when firms demand a factor of production, they do so not because that factor input gives direct satisfaction to the firms, but because the factor input enables them to produce a good which consumers desire to purchase. So suppose you want to purchase a particular furniture, okay? So to be able to produce that furniture for you, the producer will have to go out and put a demand for wood, for the best quality of wood available in the market, or for any type of wood available in the market, right? So the demand for wood is a derived demand, okay? It is arising not because the wood will give him a direct utility or a direct satisfaction, but if he buys the wood, he will be able to produce a furniture that will give you as a customer satisfaction. Fine? So that is derived demand. And last but not the least, is that all the factors of production do not have the same mobility. Okay, so do not have the same mobility means that suppose land does not have mobility. Okay, laborers and entrepreneurs are comparatively more mobile because people can move from one place to another, but big machines, which comes under capital, and land, you cannot move it from one place to another. Okay, you cannot move that particular piece of land to anywhere. Okay, you have to go out and search for another land. Okay, so mobility is not same for all the factors of production. Next up, also here we do have the definition of mobility, which refers to the ease with which a factor can move from one employment to another or from one place to another place. Price. The price of a commodity is the unit or amount of money that has to be given to get this commodity. Okay, so the amount of money that you're paying to be able to purchase it is price. Next, price of a good or service expressed in monetary units is also called absolute price or money price. Okay. Next up, we have goods like air, which are free gift of nature, is known as free goods. Okay, so air or places where you have free water, these are all free goods. You do not pay to have that. Okay. Next up, we do have the next part, but before that, under price, you please mark this part as well, that scarcity is a fundamental problem faced by all the economies because not enough resources are available to produce all the goods and services that people would like to consume. Okay, so economic goods have a price because they are useful as well as scarce in their availability. Okay, so I hope from the previous chapter 1, you are aware of what scarcity is. Okay, what does the word scarcity mean? So scarcity means that you don't have unlimited of that particular thing. Okay, so everything, there is a scarcity of everything that you can see instead of air, but any kind of resources that we use, they do have scarcity. Okay, there is a particular limit to its availability. So due to this reason, we put a price on those objects. Okay, so products or objects which have more scarcity, we tend to price it higher, and those products which have less scarcity, we tend to price them lower. Okay, for example, air is free. Why? Because it has very less scarcity, it's available in huge quantities. Water, so those places where availability of water is less, you will see that they are paying a price to be able to afford or have water. Okay, certain quantity of water. But those places where availability of water is very easy, you don't pay a price to have water. Okay, to get water to your home. So thus goods and services are available at a price because it involves some cost in producing these goods and services with the use of scarce resources. Okay. Next up, we have equilibrium price. Okay, so what is an equilibrium price? It is a price at which quantity demanded equals quantity supplied. And remember that competition among buyers and sellers ensure that the price ultimately settles down at the equilibrium price, that is at the level where quantity demanded equals quantity supplied. Okay. Next up, we have general price level. So what is general price level? It is the average level of prices of all goods and services produced in the economy. Okay, the average level of prices of all goods and services produced in the economy. Next up, there is inflation and deflation. Okay, so inflation ka definition is given here itself, which is defined as a process of persistent and appreciable rise in the general price level, and deflation is a large decrease in the general price level is called deflation. So general price level means the average price level that is prevailing in the economy right now. Okay, and when that keeps on increasing, okay, that is not just increasing for a short period of time, but it is gradually increasing for a long period of time, then we say there is inflation in the economy. Okay, so inflation is process of rising prices and not just a state of high price level. It refers to a situation of appreciable or considerable rise in prices. Rise in price should be prolonged in order to be called inflationary price rise. It should not be just a short period rise in price. Inflation is measured in terms of rate of increase in the price level as indicated by the price index given by CPI or WPI. Okay, so the rate of increase in the price level should be considerable to be considered as a inflationary rate. Okay, next up, you have demand pull and cost pull inflation. Okay. So what is demand pull and cost pull inflation? You go through the definition, that is inflation originating from the demand forces is the demand pull, and inflation referring to the price rise due to increase in cost is called cost push inflation. So demand pull inflation arises when you will see that the demand for goods and services is exceeding the supply of those goods and services at the existing price. Okay. So when suddenly demand for a commodity increases and the supply is not enough, okay, to be satisfied, what the suppliers or the producers will do, they'll increase the price, okay, so that only those people are able to afford it. I mean, only those people are able to meet the demand who can afford it. Okay. So then arises a rise in price due to demand. Okay. So demand pull. And what happens in cost push inflation? Cost push inflation arises when there is an increase in wage cost or increase in the profit margin. Okay. So if the laborers demand for a higher wage rate, and so the entrepreneur has to pay all the employees a higher wage rate now, okay, a higher wage. So when he's paying a higher salary to all of these people, from where will he give that money? He'll have to, collect that money from the market itself, right? So he increases the price of the products. Okay, that is what happens in cost push inflation. Okay, that the factor prices, when you have to pay a higher factor cost, you will obviously increase the price of your product. So then arises a cost push inflation. Next up, we will be referring to value. Value of a commodity refers to the valuation placed by a household or the consumption of a commodity. Okay, so there are two types of values. One is value in use, another is value in exchange. So value in use is the utility derived from the consumption. Simple. Okay, utility derived from the consumption, and value in exchange is the money that you are paying. Okay, so both are very different. So the utility or the happiness that the product is giving to you is your value in use, and value in exchange is the money that you're paying. Okay, and both are not the same. That is being referred to here, paradox of value. So here the example that they are giving is that water has a low exchange value. That means low price, low money. You almost don't have to pay any money, or at some places you do have to pay money to have water, but that is low compared to diamonds. Whereas if you compare water with diamonds, you need water more than diamonds because you need water to survive, right? So though water has a very high value in use, but it has low value in exchange compared to diamond. Next up, nominal value, real value. So nominal value refers to the value of a commodity measured in monetary units like rupee, whereas real value is the value referring to purchasing power of a commodity in terms of other commodities. Okay, so the barter system that used to happen before money existed, that is what real value is referring to. So the value of a product with respect to some other product, whereas value in nominal value is the money that you're paying. Okay, next up we have market. Okay, so here comes the definition of market. The word market in ordinary sense means a physical place where commodities are bought and sold, such as Connaught Place, Chandni Chowk. So they have given some examples of a market. But in economics, what is market? It means a system or a setup in which the buyers and sellers of a commodity are able to interact and communicate with each other and strike a deal about the price and the quantity to be bought and sold. Okay, so it need not necessarily be a particular place only. So the market need not be located in a particular place. Okay, next up, second point, that is buyers and sellers need not have personal contact with each other. So these two are the distinguishing facts of a market. Which distinguishing facts of a market means it is different from the word market that we use in day-to-day life. Okay, because it need not be a physical place only. It can be a online market as well, which is more prevalent now here. So next up is types of market. Two types of market exist. One is goods market, one is factor market. Goods market are those markets where goods and services are bought and sold, and factor markets are those markets where factor services are bought and sold. So what are goods market selling? Goods market is selling the ones that we are relevant with, like any goods that you're going to buy, it's goods market. But factor market is where you will get laborers, where you will get capital, where you will get land, where you will, so any factor services is being provided in factor markets. Okay, the buyers in such markets are entrepreneurs and the sellers are the owners of factors of production. Okay, so labor market is an example of a factor market. Next up is money. So here, what is barter system? If it comes, it refers to the system of exchange where goods and services are exchanged directly for other goods and services. But what do we mean by barter economy, where barter system is relevant? And what is money economy? The economy using money as a system of exchange for carrying out various types of economic transactions is a money economy. Okay. Next up, important points from here is currency, which comprises of currency notes and coins. Okay. Currency notes refer to the paper money that we use. And what is deposit money or bank money, which refers to the deposit held with the banks, which you can only get with the checks. Okay, so the cash that you carry is the currency notes, and the money that you have kept in the bank so that you can only get it once you apply check for it is the deposit money. Income is the flow of goods and services or flow of money accruing to an individual or all the people in an economy over some specified time. So income measured in terms of some monetary unit like rupee, dollar, etc. are all money income. Okay. What is factor income? Factor income is income earned by an individual largely by selling his factor services to firms. Okay. So factor income is income earned by an individual largely by selling the factor services. So wages, interest, rent, profits, these are all different types of factor incomes. Okay. Next up is what is national income? National income is the value of final goods and services produced by domestically owned factors of production during a given period. So this is very important. These are your keywords: during a given period, okay, and owned by domestically owned factors of production. I mean, when it's not just any factors of production, okay, it's not just any factors of production, it should be domestically owned factors of production. Then the income that is coming up, or the value of the final goods and services that is coming up, is being added to the national income. Next up, what are the important points of national income? First point is national income is expressed in monetary terms. Okay. Secondly, it reflects the value of final goods and services sold to the final users like households. And thirdly, it is the flow of final goods and services. Okay. Every flow concept like national income is expressed over a particular time period. Okay. It's not like for infinite time period. They'll give it. We are talking about when we are talking about national income, we might talk about an annual basis. Okay. About a yearly basis. Fine. So for a particular period of time. Next up, what is GDP? So GDP is defined as the value of all final goods and services produced by all enterprises located within the domestic territory of a country. National income is equal to GDP plus net factor income from abroad. Okay, so here we just saw that national income is equal to GDP plus net factor income from abroad. Let me tell you what is net factor income from abroad. You can see the definition from here as well. Net factor income from abroad is the difference between factor income received from abroad and the factor income accruing to the foreigners. Okay, so factor income received from abroad is if residents from here go abroad and work, so they bring in money to the country, and if foreigners come here and work, they get money to their country, right? They take away the money to their country. So after subtracting what is coming minus what is going out, we get net factor income from abroad. Okay, so national income is equal to GDP plus net factor income from abroad. So the GDP does not include all these, so hence we have to add them to get national income. Next, per capita income. So per capita income of a country is the average income of the normal residents of a country in a particular year. So per capita income is the average income of the normal residents. So when we say average, what do we mean by that? That means we are dividing national income by the population of the country. Okay. Next is saving. So in saving, we have the definition, you have the definition of saving, which is saving refers to the part of income which is not spent on consumption. Okay. So once you start earning, the amount that you have kept aside and you have not touched it, that is called saving. Okay. And other than saving, you consume it. You use it to buy something. Next up, you have small definitions. What is personal saving? What is individual saving? What is business saving? What is government saving? Okay. So what is personal saving? Done by households. What is individual saving? Done by an individual income earner. What is business saving? Done by business. And what is government saving? It is done by the central government, state governments, local authorities, and public corporations. Okay. So government saving is achieved chiefly through a budget surplus. Okay, that is when government revenue exceeds government expense. Fine. What do I mean by government expense? All these schemes and policies that the government comes up with, government is using its money to implement these schemes and policies. And what is the receipt that the government is getting? The tax that we pay. It can be in terms of GST, it can be in terms of income tax. So when the tax exceeds the money that government is putting in implementing these policies or in making roads and etc., so the surplus money that the government is left with, that goes into government saving. Next up, we have private saving and aggregate saving. So saving by individuals, by families, and by business firms is known as private saving, whereas aggregate saving is a total saving done by all the people in the economy. Fine. So savings is the total amount of saving accumulated over time. Fine. So that is all the past savings. When it gets accumulated, we say savings. Next up, we have investment. What is the definition of investment? It is defined as the act of using productive resources for the production of capital goods, that is, goods that are used for producing other goods and services in the future. So investment is when you're using productive resources for production of capital goods. Okay. What are capital goods? Capital goods are those goods which will be used for production of some other goods. Okay. Because when we were studying about factors of production, we saw that there are 4 factors of production under which comes capital. So the amount of money that you put in or the amount of resources that you put in to make these capital goods so that it can be used for some other factor of production, that is investment. Okay. Next up, the major components of investment goods are producers' fixed investment, investment in residential housing and non-residential structure, and investment in stocks. Okay, so now we have the major components of investment goods. First is producers' fixed investment. So यहाँ पे fixed investment में क्या आ रहा है? Plants, equipments, tools, machinery. So when you're investing in these type of goods, is called fixed investment. What is residential housing and non-residential structure investment? This is easy because when you're investing in the construction of a residential house or non-residential structure like office building, power plants, bridges, roads, etc., then it comes under this category. And what is investment in stocks? It is a stock of raw materials or semi-finished goods or finished goods in factories or shops for smooth production. Okay, so when you are investing in something that is adding as a stock, it will come under the third category. And when you're investing in something like plants, equipments, tools, machinery, which will be fixed for a long period of time. Okay, so there's a difference between adding stock. There's a difference between adding stock and fixed investment. Okay, so fixed are those products which will persist for a long period of time, okay, which will be there for a long period of time. And when we say that we are stocking raw materials, we are stocking semi-finished goods, we are stocking finished goods, which will help in production, but it's not a fixed, okay, it will not stay for a long period of time. You're stocking it so that it can be used for production and be sold as soon as possible. Investment required to keep the existing stock of capital intact by replacing what has been worn out or otherwise used up in the process of production is known as replacement investment or depreciation. Okay, so the investment that you're doing to keep the existing stock of capital intact by replacing what has been worn out. Okay, so what has been wasted or what has been worn out, you're replacing that and you're making a new investment so that the stock remains there. That is called replacement investment or depreciation. Okay, and by deducting depreciation from gross investment, we get net investment. So net investment is gross minus depreciation. Okay, so here we leave it till this much. Next up, we'll take wealth, okay, in the next video.